Hello, this is Jordan. This video is being recorded on Monday, July 11th, 2022. Thank you so much for joining me today. Make sure you like, comment, and subscribe. I would really appreciate it. Thank you. And in this video, I'm going to analyze gold in comparison to 2013. I did a video on this a year ago about, given the recent performance in precious metals, which has been very disappointing and troubling, I think it's worth checking out again. I think the main reason is because when you look at, if you just go by the looks, gold looks like it does in 2012 or 2013. Someone told me, I don't know, years ago, that looks, when it comes to the markets, and also women, looks will get you into a lot of trouble. So that person was much smarter than me. So and I'm going to try and keep this simple with the same chart, only 2 slides. But first, let's look at major peaks in the gold market. And so we've had 2. We've had the early 80s, and then we've had 2011 and 2012. And if we think about, first of all, how did gold perform going up to those peaks? Well, in the most recent bull market, 01 to 2012, gold was up 12 calendar years in a row. I remember Jim Rogers always made that point. And, he really had the best call after 2011, 2012, around that time. I mean, he was the only one that was pretty vocal. He wasn't saying gold was going to have this really nasty bear market, which it did, but he was pointing out, gold's going to go much higher eventually, but it's going to have a rest. It's going to have a complicated bottom after this bear market. So I do want to give him credit because he nailed it. And so that 12, I'm getting a little bit off topic, but so gold was up 12 calendar years in a row. And then gold went up, of course, in the inflationary 70s. In that bull market, gold went up 25x. And of course, the stock market was in a secular bear market. It had been for at least, 2000, 2009. I guess it was only 9 years. But, we can call it at least a decade in both cases. And so if we look at, how does gold right now compare to those 2 major peaks? And we're talking about 2013 as well, 2012, 2013. Well, gold is at the same level as it was 12 years ago. So there's no comparison there. There's no huge amount of money that's poured into gold and is not in the other markets. That's not the case right now. And if we look at, when gold had these breakdowns, that was at the beginning of, or very early in these new secular bull markets in stocks. I mean, the S&P bottomed in 74. You can say in real terms, the bull really began in 82. And so that was, after gold had this really significant breakdown in 1981. Look what happened in 2013. I mean, gold, really crashed in early 2013. But after that, the S&P broke out of a 13-year base. And look at where we are right now. I mean, right now, the odds are, if you had to bet on it, the stocks are starting a new secular bear market. They've already declined 25%. When they lose the 40-month moving average, as I've said in other videos, that is one major indicator that a new secular bear has begun. We saw that after the 1968 bear, 1929 and 2000 as well. So if you think that the stock market is going to have another leg down, it's in a new secular bear market then. So, if we look at market cycles, that means gold's going into a new secular bull. And then also you can look at many valuation things, but look at the CAPE ratio, which is one of my favorites because the CAPE ratio corresponds with long-term return potential in stocks. And you look at the early 80s, it was in single digits. If you look at 2011, it was 18, 19. We have closing prices there at the top. And so this is a quarterly chart, so it's not looking at monthly data, just only quarterly closes. But I remember looking at it more closely. So the CAPE was below 20 when gold started that big breakdown, the end of 2012 into 2013. Even in 2009, in that market bottom, the CAPE was at 13. So, and also if we look at let's look at what happened in the late 40s or even 1942. 1942, the CAPE was in single digits. Even the late 40s, CAPE was around 10. So, beginning of this year, the CAPE was nearly at 40. I haven't updated it in the last couple months. Certainly, it's a lot lower now. But you guys get the point. This is macro market looking at a big picture, bird's eye view. This is a completely different situation than what we had at the other two peaks. And let's look at how gold, what happens when gold starts secular bull markets. And here we have the S&P at the top. We have gold at the bottom. And then the gold line here is the gold against the S&P 500 ratio. And, another point, if we're looking at I should have put this in the last slide, but if we're looking at the gold line here, the gold to the S&P 500 ratio, look at where that was when gold had these big breakdowns. It had been going up for 10 years, basically. That just substantiates the point about, gold hasn't done anything in the last 12 years. But this is such an important point because if we look at what happened in 2012, 2013, in 1981, 1982, gold was underperforming in real terms badly right around the time of those breakdowns. And we know that that's been different. The quarterly gold line doesn't do that good of a job of showing it. But if we look at since the beginning of this year, bear market and stocks, gold has been consolidating. Now it's correcting significantly. Gold has been holding above the S&P, the 200-day moving average on that ratio. It might go below it the next month or two as it tries to find a bottom before the Fed ends hiking. We'll see. But again, it's a different situation. If gold were about to have this major breakdown, gold would be really weak in real terms. Two more things, but one more thing. The blue lines, the vertical thin blue lines, and you can see the arrows there in 1971, 2001, and then late 2008. When gold started those big moves, we can see that those started after, specifically the last two. Those moves began, several quarters after the stock market peaked. So even, if we look at the last two, and this is also the case if we look at gold stocks after the 1968 bear. So looking at those three situations, and I've talked about this in another video, I think, if we look at those three bear markets, gold or gold stocks bottomed around roughly a year after the bear market began, and that was around the time where the Fed started cutting interest rates. Now, there's all these different things we look at, but based on that would tell you, everything's going to bottom in 3-4 months. But gold bottomed in April 2001. The gold stocks actually bottomed in November, so that was 7 months after the fact. So nothing is always perfect, but the point is, after the bear market starts, it takes a little time, and then when the Fed shifts policy, they cut rates. That's when the big move begins in precious metals. So we're not at that point yet. I do think the Fed is going to shift sooner than the market thinks. They're going to get this July hike off. I don't think they're going to be able to hike in September. 2.5 months from now, I don't see it given the way the dollar's moving, the economic reports. There's already a little talk out today about, maybe we're hiking too fast from these Fed talkers. So when the market sniffs that they're really going to shift, that's when precious metals are going to bottom and rebound. And then when the Fed has to cut rates, that's when precious metals are going to go really crazy. Now, the last thing is, and I'll talk about this in another video. I mean, the technicals of gold, given the way things are looking, we could have a little bit of an 08 September, October situation where, maybe we have this big sell-off and gold goes below 1675 briefly. And, it's this huge bear trap. But, so I think that is a realistic possibility here. That's really the technical downside we need to focus on, not the fact that this is like some 2013 repeat, because of everything I've said. We're looking at all the facts here. There's no comparison to 2013, only that it looks similar in the charts. When you break it down, there's no comparison. But I don't want to say that, the technicals of gold are good right now, because they're not, and gold is struggling. And, there could be a flush before the Fed shifts policy. So I'll talk more about that in a future video. But thank you for listening all the way through. Really appreciate it, and look forward to doing another video for you guys in the days and weeks ahead.